Hello, in this video we'll continue of our corporate distribution discussion, and this will be corporate distribution problem number 3. Now if you have yet to watch problems 1 or 2, please make sure to watch those first because this problem series is meant to be in sequential order, learning concepts as you go. So in this problem, Kiwi owns all the stock of Fruit Sushi Inc., a C corporation that creates delicious fruit sushi. Kiwi's basis in the stock is $24,000. That's at the beginning of this problem. Assume that after several years of operation, Fruit Sushi Inc. had $36,000 of accumulated earnings and profits, EMP. During the current year, Fruit Sushi Inc. earned an additional $24,000 of EMP. So we have $36,000 accumulated EMP over the previous years, and this year we have current EMP of $24,000. The EMP was earned equally throughout the year. Now the following events occurred during the current year, other than the $24,000 of current EMP. On April 1st, Fruit Sushi distributed $40,000 cash to Kiwi. On July 1st, Kiwi sold half of her shares to Strawberry for $50,000. On December 31st, Fruit Sushi distributed $20,000 to each Kiwi and Strawberry, and now that Strawberry on December 31st owns ownership, that's why there's a distribution on December 31st versus April 1st. There's no distribution because only Kiwi owns. So Strawberry gets no distribution on April 1st, but does get a distribution on December 31st because, again, the ownership didn't take place until July 1st. So we have to consider tax consequences to Kiwi, Strawberry, and Fruit Sushi. Now, whenever you see a problem with multiple shareholders involved and lots of things going on, this is when things start getting interesting and they get a lot more challenging with respect to distributions. So if you recall, whenever we have a distribution, a corporate distribution, we always have to go through a 4-step process if it's a property distribution. Well, this is a cash distribution, so from the corporation, so it's a Section 317 property/cash distribution. And remember, as I mentioned, there's a 4-step process. So at the cash distribution, we have to go through the 4 steps. Now the first two steps, steps 1 and step 2, because it's a cash distribution, and as we talked about in the previous problem videos, there's going to be no consequences. Step 1 is determine the tax consequences of the distributions to the corporation, Fruit Sushi. Well, because it's cash, there's no gain or loss, so you don't have to worry about step 1. There's no consequences. Step 2 is to adjust current year EMP if there's any gain from step 1, and there is no gain from step 1, so we don't have to worry. So there's no consequences from steps 1 and step 2. So now we're going to focus on step 3 and step 4. But first, we're going to go to step 3. In step 3, we're going to look at the tax consequences to the shareholders. And here there's 2 shareholders receiving distributions. We have Kiwi and we have Strawberry. Kiwi receives a distribution of $40,000 on April 1st. On December 31st, both Kiwi and Strawberry receive an amount of distribution of $20,000. So that means in total, the corporation distributes $80,000 during the year, $80,000. If you recall, step 3, when we consider the tax consequences to the shareholders, and there's 2 shareholders here that we have to consider, this is usually where the meat of the analysis is, and this is going to be a challenging one because we have a lot of stuff going on. So, if you recall, within step 3, there's 3 more sub-steps. There's 3 more sub-steps. The first step is determine the amount of the distribution. Well, if it's a cash distribution, the amount of the distribution is the amount of cash. So the distribution equals the amount of cash. Now, when you have multiple dates like this, it's best to break up by date. So what we're saying is that on April 1st, the amount of the distribution to Kiwi is $40,000. On December 31st, the amount of the distribution is $20,000 to Kiwi and $20,000 to Strawberry. And that, again, those 3 numbers sum to $80,000. So the amount of the distribution is the amount of cash because there's no fair market value of property. There's no property here, and you don't have to subtract away any liabilities that were assumed or taken subject to with respect to the shareholders. So you don't have to worry about that. It's simply just the amount of cash. Step 2, or sub-step 2, I should say, within step 3, is to determine the amount of E&P, because remember, step 3, we're going to have to do the waterfall. And step 2 and step 3 are really going to have to be done together here, because when you have multiple distributions during the year, you have to really take into account the amount of E&P. Because if you look at this, you should always start by asking, what is the accumulated E&P and what is the current E&P? Because that a lot of times will give you an indicator. Accumulated E&P and current E&P. And again, the current E&P, as we saw in previous problems, is after number 2, after step 2, which here there's no adjustment. So the accumulated E&P is a positive 36,000. A positive 36,000. The current E&P is $24,000. 24,000 we're told. So here's the accumulated E&P, 36,000, and here's the current E&P, 24,000. So that is the amount of E&P that we have. Now note that it's positive and positive in both years. So when it's positive in both years, you can go ahead and add it together. 36 plus 24, that's going to give us 60,000. Now if the amount of total E&P from this sub-step 2 is greater than the amount of distributions for the year, then that's fine. But if it's not, and again, it's all positives, like we have here, accumulated and current, we have to do a special analysis. And there's some special rules that we're going to talk about. And really, we're going to have to do sub-steps 2 and 3 together when you have this type of situation. So again, to summarize, when you have a positive accumulated E&P and a positive current E&P, go ahead and add them together. If the total of those two, or the sum of those two, is greater than the amount of the total distribution, which here is 80,000, then you can go ahead and simply just apply it to step 3 and everything will be a dividend. But that's not what we have here. Here we have less. When you have less, you're going to have to do a special analysis. So with respect to sub-step 2, we're still there. There's really 2 special rules that we have to talk about. So, and that really deals with accumulated E&P and current E&P. So in regulation 1.316-1, so this is under section 316, the regs, it states that current E&P will be prorated throughout the year. So current E&P will be prorated, and I'll show you this later. So pro rata, it'll be on a pro rata basis. And then after we do that current E&P, so that's the first step. So it's a step within a step within a step. I know lots of steps here. Again, we're going to go through all this, so don't worry. So current E&P is going to be on a pro rata basis based on the total amounts of the distributions during the year and the amount of current E&P. And then accumulated E&P will be allocated on a first in, first out basis. Basically, first come, first serve of what's left. And then whatever is left over, you're going to allocate that out as you go. Okay, so you'll see what I mean. So there's really no pro rata analysis with accumulated E&P. That's what the current is. So now that we know those rules, we're going to have to go through this. And the best way to do this is to kind of draw a chart going through each of these items. So that's what we're going to do right now. Okay, so just a reminder, it's $80,000 total in distributions. And then we just saw what we calculated is that the total E&P we calculated out, accumulated plus current, is 60,000. So that's how much E&P we have in total to allocate out. But again, we're applying certain rules. And again, current year E&P will be allocated on a pro rata basis, looking at all the different events. Again, because current year E&P is always determined at the end of the year, and we look at the distributions at the end of the year, just like we saw in previous problems. The idea is that you're preparing corporate tax, you're preparing your taxes for your individuals at the end of the year when everything is done. It's all finalized. So you can do it based on an end of the year analysis, and that's what we do. And then accumulated E&P is used on a pro rata basis. FIFO, first in, first out. All right. So best thing to do is kind of to create a little chart, okay, where we have the date, we have the distribution amount, we have current E&P, accumulated E&P, and finally, the amount that's considered a dividend from that respective distribution. Okay. And we can break it down by each owner as well. This is basically, we're within step 3, again, determining tax consequences as shareholder, and we're looking at basically sub-step 2, EMP, and sub-step 3. You got to do these together, because what you're going to see is we got to go through it chronologically because of the FIFO aspect of the accumulated EMP. Because again, it's not enough, right? This is not enough, this determination, this 60,000, it's not enough. So we got to do this by date. So we go chronologically. Well, actually, we start the year, right? On January 1st, we have accumulated EMP, or we can just go ahead and say current year EMP when we start the year is 24,000. Now, that's not, it's really allocated throughout the time, and again, end of the year, but for simplicity, what we're going to do is we're going to use that number. We're going to use that, okay, in determining that. That's what we have for the year, okay? Or if you just want to call it, if it's easier, just go ahead and say for the year in this calculation, current year EMP is 24,000 and accumulated EMP is 36,000. All right, so then we go to our first distribution on 4/1. We have a $40,000 distribution to Kiwi, a $40,000 distribution to Kiwi. Okay. Now, before we go through and we do the current year EMP, accumulated EMP, and dividend, let's just go ahead and put in these items with respect to each date. And again, this is meant to be with respect to the distributions. Yes, there's a sale of some stock, but that's not a distribution. We'll talk about the effect of that after we do this chart. Okay. So let's go to 12/31. On 12/31, we have our next set of distributions, and we have 2 distributions on 12/31. The first is, well, they're both together. They're both part of the same idea. We have $20,000 to Kiwi, and we have $20,000 to Strawberry. Okay, so now we can go ahead and we can start to do our analysis for current year EMP and what's actually accumulated EMP. We can total that, and then whatever portion there is considered the dividend. And that's the important part, is the dividend. And by the way, I'm going to put the dates right here. 4/1 again, K for Kiwi. 12/31, K for Kiwi, because we're going to need this column later on. We're going to need it. 12/31, S for Strawberry. We're going to need these amounts later on. You'll see why, because we're going to need this space later on. So what we do is, if we add up all the amount of distributions, which we already did, there's $80,000 total in distributions. If we apply our first rule, okay, let's give us some space down here. So if you remember, the first rule that we talked about with respect to the EMP was the current year EMP pro rata. And I'm going to show you how exactly we do it. And basically the idea is that we don't look at first in, first out, or last in, first out. We just take the amount of current year EMP. So the formula is current year EMP over total distributions for the year. So the current year EMP is 24,000. Total distributions for the year equal 80,000. If you determine this ratio, this is 30%. This is equal to 30%. So that means that the current year EMP that's going to be allocated from these amounts, the distributions, is going to be 30%. So this 30% will be multiplied by these distribution percentages. So let's go ahead and do that. Before I do that, this year number is the total. This is what the total is going to be. So that just keeps track of everything. So 40,000 to Kiwi on April 1st. 40,000 times 30%, 12,000. 12,000 of current EMP is going to be allocated to this transaction. Then these 20,000 and 20,000, 20,000 times 30%, and 20,000 times 30%, 6,000, 6,000. And a good way to check your work is if these three numbers sum up to 24,000. You got it right. So 12 plus 6 plus 6 is 24,000. So we did it properly. That allocation is proper. So now what we do for the accumulated E&P is we basically go through on a FIFO basis. That's rule number 2. Rule number 2 is that accumulated E&P is FIFO, first in, first out, but it's applied after current E&P. So we apply rule 1 first, then we apply rule 2. So this is what we do. We go chronologically in order. So we go down the line in order from April 1st all the way down to December 31st. So 40,000 distribution to Kiwi, 12,000 of that is current E&P. So the question becomes, these two numbers cannot exceed 40,000. So we do FIFO, which means we can do as much. We don't do some type of pro rata analysis for all three of these numbers. We just go by the dates, okay? So to do some math here, we're going to take 40 minus 12, and that number is what we need from the accumulated E&P. Again, because it's FIFO, we can use all of it. And obviously 36 plus 12, what is that? That's 48,000. That's well more than 40, so we're good here. Now, obviously, if there wasn't enough to cover to get to 40,000, you just use all the accumulated E&P. But we have more than that. So we're going to do some math over here on the side. 40 minus 12. 40 minus 12, and that gives us 28. So 28,000 is what the accumulated E&P is with respect to this line, 4-1. Now, we have an interesting situation. On December 31st, we have a balance left in accumulated E&P after April 1st of 36 minus 28, which is 8,000. There's 8,000 left, right? This is going to be 36 minus 28, which is, these are all thousands, Ks, right? So this is 8,000. Now, if you have two distributions on the same date, you use a pro rata approach here. So that's another rule under the regs. If you have the same date, then whatever amount you have left from the accumulated E&P from the FIFO, this is our balance left on this date to use, 8,000, then you're going to split that, or you're going to do a pro rata just like you did here. But because these amounts are equal, 20 and 20, this is what you're using. You're using 20 and 20. So 20 over 40, 20 over 40, because you're taking the amount of distribution over the total. And again, this is 40,000 in total. 40,000 in total. So that's what we're doing, 20 over 40, 20 over 40. So that means if you take 20 over 40 times 8,000, or 20 over 40 times 8,000, you get 4,000 for these. So 4,000. So this is 20 over 40. Basically, because of the same amounts, you're basically going to divide this amount by 2. That's the idea. But you apply the same type of pro rata approach. You would take the amount of the distribution on the top over the remaining amount of accumulated E&P. That would be the formula. Which here, the amount of the distribution for Kiwi is 20,000 over the total is 40. Sorry, I said earlier that you take the accumulated E&P that's left over. No, you take whatever portion of this is left, and then you multiply that by the remaining E&P. That's how you do the formula. So again, 20 over the 40,000 total distribution on December 31st times the 8,000 remaining gives us 4 and 4. So that means that the total amount of dividend on these dates on April 1st for Kiwi, for the 40,000 distribution, all 40,000 is considered dividend. How do I get that? 12,000 plus 28. You add these two numbers together. For 12/31, the 20,000 distribution of cash to Kiwi, 6 plus 4 is 10. 10,000 of that is considered a dividend because we got to use E&P. And then for Strawberry on December 31st, the 20,000 distribution to Strawberry, 6 plus 4 is 10. 10,000 here. And the way to check your work is that we have a total of 60,000 of total E&P to allocate. 40 plus 10 is 60. So we've allocated properly all 60,000. And a way to check our work is that, for regarding distributions, is that 80,000 equals 80,000, and then E&P, 60,000 equals 60,000. Boom, we've done this properly. So it got a little bit challenging there, but as you saw, to summarize, we again apply current year E&P on a pro rata basis right? Current year EMP is the amount, the formula for the pro rata is the current year EMP over the total distributions, 24 over 80, which is 30%. And then FIFO, first in, first out for accumulated EMP. So April 1st got as much to fill it up to the 40, that's the max. And then 36 minus 28, 8,000 remaining was allocated based on whatever amount of distribution went on that date, because there's only one date left. Now, if there was a date in the middle here, then that would be next, and then we go, if there's anything left after that, to that one. So it just goes in order. You allocate accumulated EMP in order by the amount. By the date. And that, then the amount keeps going down and down. That balance keeps going down. Okay? So now what we're going to do is we're going to do our final step 3 part, substep 3, step 3, and talk about the actual consequences along with the basis implications. But I'm going to keep this little area over here, the amount of dividend. But if you have to go back to this calculation to see how I got the dividend number, please come back to this. But all we really need from this is this little area over here. All right, so we're not done with step 3 because remember, step 3 is to determine the tax consequences with respect to all of the items of a corporate distribution, all the events for the shareholders. So just hold your horses. We're almost there. The hard part is really over, the determination of the amount of a dividend from the EMP, or the EMP that's allocated, as I like to call it. So we'll just keep that separated because we're going to need that. So now we're at the last part of the of step 3, determining the tax consequences to the shareholders, kiwi and strawberry. We got to do fruit sushi and step 4 at the end, because remember, step 1, step 2, there were no consequences to fruit sushi. So the best way to do this is simply just go through the order of dates, because we also have to worry about July 1st, because that's also going to provide tax consequences. Okay, I said of these events. So it's not just distributions, it's also sale. So the first thing we're doing is we're looking on April 1st, and on April 1st, there was only one owner, Kiwi, because Strawberry did not acquire ownership until July 1st, half of Kiwi's shares. So for April 1st, we're talking about the $40,000 distribution to Kiwi. Okay? So really what we're doing here is we're taking the $40,000 distribution, right, that we determined from step 1, which was the amount of cash, right? We know what our dividend is, or our EMP. That's the first part of our waterfall. So the first step in our waterfall is to determine the EMP, because that equals the amount of the dividend, and the amount of the EMP, which is dividend here, is $40,000. That was what that chart helped us do. So that means that number 2, return of capital, ROC, is 0. And then number 3, capital gain distribution is also 0. So that's the consequences with respect to April 1st. To Kiwi, we did that. It's $40,000 is all a dividend. Okay, so now we go to July 1st. And Strawberry is purchasing the shares. So the only consequences to Strawberry on July 1st are simply Strawberry now has a basis in the shares of $50,000, which we're going to need that for December 31st. You'll see why later on, okay? But that's not really any tax consequences that are reported on the tax return. Now, it'll be reported if there's a sale of the shares or a distribution where we need the basis later on, which we'll see in December 31st. But really, July 1st only deals with Kiwi, the sale. So on July 1st, that is 7/1, Kiwi sells half of her shares to Strawberry for $50,000. For $50,000. So we have $50,000 sale, and that's with respect to Kiwi, right? Now, this is a sale of stock. So whenever we have a sale of stock, we apply our normal section 1001, amount realized minus adjusted basis. I'm bringing back old memories, right? You might be remembering back to some of the previous videos. This is always the gateway provision, right? You're selling stock, you got to go through this. And that gives us the realized gain or loss, which I'll just go ahead and tell you. Here, it's going to be recognized because, remember, whenever you're selling for cash, there's never a way to really, it's almost never likely you're going to be able to get a non-recognition rule. So the amount realized here is the amount received to Kiwi, which is $50,000 minus the basis. So the next thing we're determining is the basis of the shares. So let's just start by looking at the total basis. 24,000 is what we're told in the problem, but that's before we take into account April 1st. But we don't have to worry about anything because return of capital is 0. Now, if this number was different, if this was an actual number, it would lower the overall basis. But we don't have that here. So we have a $24,000 basis, but hold on. Kiwi is selling half of her shares to Strawberry, half. So under the regulations in the Internal Revenue Code dealing with basis, specifically Reg 1.1012-1, when you're dealing with basis and you're selling off part of your shares, then you basically use a pro rata approach. So we take 24,000 basis, this is a calculation here, 24,000 times 1/2 because we're selling 1/2. So 1/2 is being sold. It's what you're getting, 50,000, minus what you're giving up. You're giving up half of the shares. So 24,000 times 1/2 is 12,000. So that means we have a gain here of 38,000. And assuming that this has been held, these shares of stock have been held for more than a year, and it looks like that because it says that assume after several years. So since Kiwi has owned all the stock for a long time, this is going to be a long-term capital gain because the shares have been held for several years, more than a year. So it's 38,000 long-term capital gain with respect to this sale. Okay. By the way, the basis in the other half of the shares is 12,000 as well. So we have 12,000 basis going forward after this. And we're going to need that for the next thing possibly. So that's very important to understand because half the shares were sold. Okay, so on December 31st, I'm going to write really small here. We have 2 things left. And this is kind of going to be, more of a summary, but I will go through the full thing. So 12/31, we have 2 things. We have distributions of 20,000 to K. And also on 12/31, we have distributions of 20,000 to S, Strawberry. So we're going to break this up just like we did. It's the amount of the distribution. So 20,000 is the amount of the distribution. Rather than write out the full items here, I'm just going to put 1, 2, and 3. Okay, but I'll summarize them, of course, and I'll say them so you'll have them. But it really is 1, 2, and 3. 1 being E&P, 2 being return of capital, 3 being capital gain distribution. We have to break them up in the waterfall as well, the Section 301 waterfall. Okay, so we have 1, 2, and 3. 1 being the amount of the dividend, 2 being return of capital, and 3 being the amount of capital gain distribution. We have to do this for both Kiwi and Strawberry to determine the tax consequences. Okay, so for the dividend, it's 10,000 for each. So that's the amount of the dividend is 10,000 for each. And this is why you can't do it together because they have different bases. Okay, so step 2 for K, I'll put this down here. So it's a $10,000 dividend. Step 2, we have to get a total of 20,000. We only have 10,000 dividend because that's what we determined from our previous step. Step 2, we do return of capital, right? ROC. For step 2, we look at the basis that K has in her shares, Kiwi has in her shares. Well, remember, since half the shares were sold, there's 24,000 times 1/2, only 12,000 left. But good thing is that 20 minus 10, return of capital is going to be 10,000. There's going to be no capital gain distribution. Number 3 will be 0. So it's a $10,000 return of capital for K and a $10,000 dividend. Same thing with respect to Strawberry. Strawberry purchased half the shares for 50,000, so there's enough basis. Return of capital Strawberry has a ton of basis. So we have a $10,000 return of capital, and that means that Strawberry is going to have a 0 capital gain distribution, which is number 3. If I said return of capital earlier for Kiwi, I meant to say number 3 is capital gain distribution. So they actually both have the same consequences with respect to the distribution here. 10,000 dividend, 10,000 return of capital. However, they do have different bases. The basis for each going forward is different. So we need to determine the adjusted basis at the end of the year. This is always important because if I ask you what's the basis to Kiwi after April 1st, it would be, okay, 24,000, no return of capital, so we don't have to worry about it. If I asked you what the basis was to Kiwi after July 1st, after this transaction, it would be 12,000 because half the shares are gone. The basis to Strawberry is 50,000 because that's what Strawberry purchased the shares at under the cost basis principle of Section 1012. Strawberry pays $50,000. But what about the basis for Kiwi and Strawberry in the shares after December 31st? Okay, so we need to do that. So Kiwi, we started after July 1st with 12,000 minus, so that's our beginning adjusted basis, minus return of capital of 10,000. So the ending adjusted basis, to Kiwi is $2,000. So that's what Kiwi ends with at the end of all these transactions is 2,000. Now Strawberry started with 50,000 minus 10,000 return of capital equals 40,000. 40,000 basis. That's for Strawberry. Sorry about that. So 50,000 beginning of basis, that's what Strawberry paid, minus 10,000 return of capital, that's the 10,000 here, equals 40,000 basis. So here are the ultimate results of step 3. So we're done with step 3. We just finished step 3, which again is to determine tax consequences to the shareholders, Kiwi and Strawberry. So let's go in order by date. It's best to do it by order because you got so much stuff going on. So the April 1st distribution of 40,000 to Kiwi, all 40,000 is considered a dividend. No return of capital, no capital gain distribution. The July 1st, Kiwi selling off half her shares to Strawberry for $50,000. There is a $38,000 long-term capital gain to Kiwi. That's the Kiwi, right? And Kiwi has remaining basis in the half the stock left over of 12,000 because it's 24 times 1/2 is 24 times 1/2 is 12. So 12 left over. Then on December 31st, each Kiwi and Strawberry both receive a $20,000 distribution. 10,000, they both have the same consequences with respect to distribution. 10,000 is dividend and 10,000 is return of capital, no capital gain. The basis after this, after all these transactions, so at the end of the year, after all transactions, Kiwi has a basis in the half shares remaining of 2,000. Strawberry has a basis in the half shares that were received, and that's what Strawberry now owns, of 40,000. So now we're going to go look at step 4 and we'll be done with this problem. Recall that step 4, we're determining the accumulated, or we're going to adjust the accumulated EMP for the corporation, which here is Fruit Sushi. Now, steps 1, 2, and 4 really involve the corporation, the tax consequence of the corporation. But remember, you got to do step 1 and 2 before you do step 3 because you need to adjust current year EMP for the calculation of step 3. But remember, because it's a cash distribution, there are no consequences with respect to step 1 and 2. So really, step 4 is the final step and really where you only see the issue with respect to the corporation Fruit Sushi. Now remember that in order to adjust the accumulated EMP, we really have a 4-part formula. We start with the beginning accumulated EMP, which we're told in this problem, the accumulated EMP is 36,000. So that rolls over. That's the at the beginning of this year, the year at issue. So that's 36,000. Then we add to that the current year EMP that we're told. Not step 2 EMP, the current year EMP that we're told. We add or subtract depending on the situation, if it's negative or positive. Okay, here it's a positive 24,000. So this is plus 24,000. We also add any step 2 gain. Any step 2 gain that we have. Which here we don't have any step 2 gain because again it's a cash distribution. There was no effect with respect to step 2. Finally, we subtract away the distribution adjustment, which remember from our previous videos is almost always going to be the dividend amount, the total dividend amount, which remember, we determined that earlier. So 40 plus 10 plus 10, 60,000. That's the amount in total that the shareholders treat as a dividend with respect to their April 1st and December 31st distributions. They treated 60,000 in total, which, hey, that's the total EMP that we had when we looked at accumulated plus current EMP, so it worked out. So that's the distribution adjustment. The only time when it's not going to be the amount of dividend is when, again, it's a property distribution that the adjusted basis is greater than the fair market value, which you'll see we use a different adjustment for that. But that's all we have here. So we use the dividend. So we subtract away 60,000. And look at this. The ending accumulated EMP, which is what the beginning balance is for next year, rolls over, is going to be 0, which makes sense because we used all 60,000. When you have more distributions than total positive accumulated EMP and current EMP, you're going to end up with a 0 balance because you're going to use all the EMP during the year. Because we had 60,000 EMP total, we allocated all 60,000 out through step 3 process. So I know this is a really long video and there's a lot of stuff. You definitely want to go back over this. You want to master this. There's a lot of good things in here, especially those rules regarding what happens when you have positive accumulated EMP and positive current EMP. And remember, we apply the current EMP rule first, pro rata, and then we do the FIFO for accumulated EMP. So I really hope that this video helps you understand what's going on. Please continue with the other problems in this problem set because there will be more topics and issues that you're going to learn about.